My name's Evan Jordan, and this is my Bloomberg-based project for Finance 451 with John Cresson. My company that I chose is Anheuser-Busch, and I chose the beverage industry. Anheuser-Busch is an American-based company out of St. Louis, Missouri, is where the headquarters is. Since 2008, it's a whole-owned subsidiary of Anheuser-Busch InBev. Anheuser-Busch InBev, their headquarters are in Leuven, Belgium. It's a Belgian/Brazilian beverage company. But anyway, back to Anheuser-Busch. The company, in addition to Bud Light and Budweiser, has 100 different brands and types of beer. It's also the world's largest brewery. 98% of the beer that is produced in the U.S. by Anheuser-Busch is consumed in the U.S. So, I mean, you can look at that two different ways. Like, it's good that they're producing beer and it's not being exported. The company also brought in $13.8 billion in revenue and has about 17,000 employees over its past year. So today we're going to look at the financial analysis of the company. It's definitely the beverage industry. There's other companies that we're going to be comparing it to, like Coca-Cola, Dr. Pepper, Monster Energy, and Mondelez. So we're going to look at the solvency and the management of Anheuser-Busch. Basically, we're looking at the efficiency and is it a good investment to invest in. We're also going to compare it to the other firms as well. So all of this data was pulled from Bloomberg on November the 10th of 2018. There also is a quote in here pulled from Yahoo Finance about their pricing, but that's going to be at the very end. Actually, it's not Yahoo Finance, it's CNN Business, I apologize. So this is Anheuser-Busch Brewery. This is what I kind of a template we made on Bloomberg. This is all the data that's pulled from it. So you have your short-term solvency and your current quick and cash ratios. You have your long-term solvency and your financial leverage and your EBIT over interest. You have your total asset turnover. You also have your profitability ratios, and it's also broken down from your profit margin, your ROA, the return on common equity, the tax burden, the interest burden, and the operating margin. Then we go down to your market ratios with PE and the market to book ratio. We also have the WACC, the weighted economic value, we have the WACC, and then we also have the economic value added along with it. And we also have the enterprise value, and then it's the last stock price. So as you can tell from the company, this is over the past 5 years. In 2016, they had a very high PE ratio, which is not necessarily bad, but it was out of the norm. So I just think that their sales had increased a lot, and their price increased not as much. So I mean, their earnings per share were very, very good. So we're gonna go look at the aspects of the analysis. We're gonna look at the short-term solvency, which I just went over, the long-term solvency, the asset efficiency, the profitability, the marketability, and the WACC and EVA. Okay, so first we're going to look at their short-term solvency. So on the left we have Budweiser, and on the right we have Monster. When it comes to short-term solvency, Anheuser-Busch isn't looking too hot compared to other companies. But also, I'd like to point out that Budweiser or Anheuser-Busch only makes beer, so they're kind of stuck into one type of beverage made. Where on the other hand is, like, Coca-Cola has a diversity of products. They have Coke, Diet Coke, Powerade, kind of, all kind of different, variety of things. Next there's also like Dr. Pepper, also has Dr. Pepper and Snapple, which does as a variety of types of drinks that can be made. But then if you look at Monster only really has energy drinks and maybe a few other things, like coffee or something like that, but honestly, they're pretty similar in the types of stuff that they produce. So if you look on the left at Anheuser-Busch, their current ratio for last year was 0.6617. The quick ratio is 0.5466, and their cash ratio is 0.352. And then if you look at Monster, you have a 0.37233 and 2.9463 and 2.1443. So looking at these ratios, you can clearly see that Anheuser-Busch is a little bit slacking in their short-term solvency, which isn't necessarily a bad thing, but it's also not necessarily a good thing either. But if you look back a year at 2016, so Anheuser-Busch in 2016 had a 1.076.07, whereas Monster came off of a big downfall from 8.77 to 3.0436. So it looks like they've had their ups and downs, but they're not too bad off. Next, we're going to look at their long-term solvency. We're going to look at the debt-to-equity ratio of all 5 companies here, and I've ranked them by the highest to the lowest. So Monster has the lowest here in their debt-to-equity ratio, and then Coca-Cola would have the highest, and Anheuser-Busch comes in right in the middle of the pack at 3.5. So basically, with their steady increase of debt-to-equity ratio over the past 5 years, it's looking upwards for Anheuser-Busch. In comparison with Monster, they're doing very, very well. It's just not as good as you could compare to the two top of the basically line beverage companies in Coca-Cola and Dr. Pepper. So financial leverage is looking at the capital structure and determining whether you can afford your own debt. So clearly, Anheuser-Busch can afford their debt with a positive debt-to-equity ratio. So next, we're going to flip over to the profitability. So we're going to look at the breakdown of ROE. So we're going to break down ROE into profit margin, total asset turnover, and equity multiplier. So your profit margin, looking at 2016 to 2017, 2017 looks good. Your ROE looks good. In 2016, they had a high PE ratio, so the price to earnings ratio was really high, but their ROE was very, very low. Another profitability ratio is ROA. I don't have it very listed into my PowerPoint, but ROA determination is the determination of how much money you can make off of your assets. So ROE is the most important accounting ratio. So if we look at 2017, their profit margin is clearly driving the number up because of how high it is. So the profit margin was very, very high in 2017 and really are not as high in 2016. It's more normalized. So therefore, this high 2017 profit margin ratio makes the company's return look weaker, but it's not necessarily weaker. It's just they had just an outlying number in their profit margin. Next, we're going to look at the total asset turnover, the WACC, the EVA, and the marketability. So the total asset turnover, it's steadily declining over the past 5 years, which isn't very good. This means that Anheuser-Busch isn't using their assets efficiently year to year. So what they have in assets is growing, but their sales aren't increasing as much as it should. But when looking and comparing to other companies, it shows up last in the pack of 5 here. But this is a very key ratio to look at when you're investing in something. Next, we're going to move on to the WACC and the EVA. So it's been negative over the past 2 years, but the future is looking upward. So they have a prediction on there that it was looking with a negative WACC of 2. Here, we can go back and look. So if you look at the bottom here, so last year they had a negative WACC of 2007, 97.83, or 2016, and then 2017 that had a negative 599.94. So that looks to be going back up, for their predictions, to negative 236. So it looks to be going back up, which is good. We're also going to look at the economic value added spread. So the EVA spread is basically the return that your investors want versus the return that you actually got. So the EVA spread for 2017 was negative 2.74, and the predictions for 2018 are negative 1.3. So it looks good. They're trying to get those numbers back up, but they're still not investing, or they're still not getting the returns that the investors want. So we're trying to get back up to those good terms. The last one we're going to look at is the market ratio, the marketability ratio. This is going to be, so we're going to look at the PE, and it's telling the company's how its earnings come from its past. So it's essentially the profit over the investment to look at in the company. The PE for Anheuser-Busch is way up in 2016 at almost 153. We touched on that earlier. So they were essentially overpaying for the stock. The price was high, but you were still making the normal return. In 2017, it was back down to its normal 27, or roughly in the 20 range. The average for all the firms in 2017 was about 28, so Anheuser-Busch is actually doing about the average for the other one. But in comparison to one of the most traded beverage companies in Coca-Cola, it was higher. So Coca-Cola had a lower PE ratio. The market to book comparison is what you think of when your firm is compared to the market, or you're comparing how the market thinks your firm's going to do compared to how you think your firm's going to do. The market is actually lower. The market is lower for Anheuser-Busch compared to Coke because the market thinks more of Coke in the long run, with how many diverse products they have. Also, I'm just going to touch on the price estimate to wrap things up. So, according to CNN Business, 12-month price forecasts for Anheuser-Busch have a median of 95, and the highest estimate is at 128, and the lowest estimate is at 75. So the median estimate represents a 24.7% increase from the last price of 76.16. Basically, this is saying that they think that the stock over the next 12 months is going to rise to $95, and it's currently at 76.16. So that would be a 24.7% increase than what it's already at. So all in all, I think Anheuser-Busch could potentially be a decent investment. It's not necessarily the top of the line beverage industry you want to invest in, but it could possibly be one in the future. Thank you.